So in this lecture, we'll be talking about how the market responds to changes in price and moves towards an equilibrium price. So what is equilibrium? Equilibrium occurs in a market at the price where the quantity demanded and the quantity supplied are exactly equal. So let's write this definition down. So this is very important, understanding the concept of the equilibrium or market price. So the equilibrium occurs when the quantity supplied is equal to the quantity demanded. And what this means is there is an efficient allocation of resources and there is no shortage or surplus in supply. So let's look at the two concepts behind how a market moves towards an equilibrium price. So firstly, we have a shortage, and secondly, we have a surplus. Okay, let's look at the graphs underlying a shortage. So you have a supply curve which is upward sloping, and we talked about why the supply curve is upward sloping, and we also have a demand curve which is downward sloping, and we talked about why this demand curve is downward sloping in previous lectures. So at the point where there is a shortage, so the price of a certain good or service is at P1, and as you can see, if you draw this horizontal line across, you can see that the price which is supplied is only at Q1, and the quantity demanded at that price P1 is Q2. And as you can see that there is a shortage in supply here. So this is the quantity demanded, and this is the quantity supplied. So not everyone can buy the product at that price because there is only Q1 supply. So people want to buy Q2 worth of goods or services, but at that price, because producers don't see any profit opportunities or very low profit opportunities, they're only willing to supply at Q1. So what the market does here is that the price, the producers see that because there is such high demand for their products, so at the end of the day, all their inventories for that day, which are their goods or what they sell, have been sold, they have the scope to increase their price. And so what that means is they will slowly increase their price to a point at P2. And at P2, we can see that the quantity supplied is equal to the quantity demanded. And let's call this QE for equilibrium. And so this process is not perfect. So what the producer does is they slowly move along the supply line. So this is also called an expansion in supply. So when the price changes and there's an increase in price that go along with it, it is called an expansion. And this only occurs because the price has changed, and not because of any supply side factor that have changed the causes. It is only because there is a shortage in the market at Q1, and producers are aware of this because they have sold all their inventory at the end of the day, and they have increased their price to P2 where there's an equilibrium. And this is the concept of how producers move from a shortage to equilibrium. And of course, in reality, sometimes producers might move up to this point here and see that there is a surplus in production, and therefore it is very much a trial and error basis where the producer moves back to equilibrium. Okay, so now we've got the shortage under control, we talk about how a surplus moves towards an equilibrium. So we have the same upward sloping supply curve and the same downward sloping demand curve. When the price is above the equilibrium or market price at P1, we can see that the quantity demanded is only at Q1 and the quantity supplied is at Q2. So why is the quantity demanded only at Q1? Yeah, it's because buyers prefer to purchase at a relatively lower price, and while producers or suppliers prefer to sell at a relatively high price. So there is an apparent conflict here of interest between buyers and sellers. So buyers aren't willing to pay the excess price, while suppliers aren't willing to supply at the lower price. So here we have a surplus of goods supplied. So what happens is the price of the producer, the price supplied by the producer will slowly approach equilibrium. So because there have been excess inventory at the end of the day, the suppliers will see that they're required to decrease their price to get rid of all their inventory, and so eventually the market will reach a point at P. Let's just call this PE for equilibrium. So PE, which corresponds to this point here, which corresponds to QE for the quantity at equilibrium. And what this means is at this point resources are allocated efficiently and there is no excess in supply or there is no excess in demand. And so this is how the market moves from a shortage or a surplus back to equilibrium point. And at the point of equilibrium, resources are allocated effectively so that there is no excess or shortage in supply.